Welcome back to one of our episodes of Fundamental Analysis, and today we'll be talking about one of the ratios that we can use to actually evaluate securities and specifically stocks. And here we'll talk about price to earnings ratio. Using the price to earnings ratio, we can actually try to come up with a valuation for stocks. So what's included in here? From its name, it's simple. It has the price of the stock and it has the earnings per share, or what we call as, or abbreviate as, EPS, earnings per share. So we have the price of the stock and we have the EPS. The P ratio is basically taking the price of the stock, then we divide it by the EPS. Okay, so let's take it one by one. Let's look at the first term, which is the price. The price can be different. It can be any different time horizon. For example, we can use the price today, which we would call P0, or we could use a different price. We could also use the price end of last year. For example, it could be the price of the stock at the end of 2015. So we can look at the price today, or we can look at the price at any period of time. So in terms of EPS, earnings per share, so we can use different types of prices, but now how about earnings? We can use also different types of earnings. For example, we could use the future EPS of the stock, let's say for the year 2016, assuming that 2016 is yet to come or yet to take place, or let's say we use the EPS of 2017. These are all future expectations. Why? Because investors usually buy the stock for the future earning power of the stock. We could also use the historical EPS, looking at what has actually happened in the past, looking at the historical earnings of 2015, or we could use the trailing 12-month earnings. To calculate future EPS, what do you need? You need to be able to forecast the performance of the company that you're looking at, or you can use the consensus estimates of the forecasts done by different financial analysts in the market. So, for example, you would look at the different financial statements for any specific company. You could look at 2015, 2016, and 2017. And these are the numbers that you can get from different sources like Bloomberg or Thomson Reuters, and 2015 will be the actual, then the forecast for 2016 and 17. You can have the revenues for all these years, you can have the costs, and end up with the earnings. So this is for the future. How about the history? The historical EPS. Basically, for net earnings or historical EPS, you need the net earnings or the net income of the company. But which period is that? You need to look at the earnings of 2015. So you look at the historical numbers, you look at the bottom line of the income statement of 2015. This is very easy if you can look up the EPS to 2015 or any previous year. But the important thing for the trailing 12 months, you need to have different sets of financial statements. Basically, you need a couple of financial statements, only a couple of financial statements. One, you can have, for example, the 9 months results ending September 2016, and you need to calculate the 12 months period ending in that month, September 2016. So how do you calculate this? Basically, you need two sets of financials. one that includes the 9 months from January to September 2016, and you need the fiscal year 2015, where you can come up with the last quarter of last year. You add them up together and you get the 12 months earnings. With this, we end this episode and we talk about earnings per share and how you value stocks in the coming episodes. Thank you very much.